The gold price has been skyrocketing so far in 2025, hitting new record highs of over $4,000 an ounce in early October. What's behind this? Where might we be going from here? And how may you, as an investor, take advantage of this? There are multiple factors that can help drive the gold price. One is fear of inflation. Gold is seen as a universal currency in a way and a store of wealth, and has been for much of human history. Used as a currency in ancient times in coins, and even now a way of storing your wealth that isn't going to suffer some of the risks of inflation that come with fiat currencies. A second driver of gold is as a store of wealth, it's seen as a safe haven in challenging times, and particularly in times of political uncertainty. Right now, we have a government shutdown going on in the United States, and that's adding quite a bit of uncertainty. As well, there are global trade negotiations going on that have roiled markets at times, and particularly between the US and China, there have been some challenges. Just over the last week, China has added restrictions on export of rare earth elements, which they dominate the supply of. The United States and the Trump administration has responded by threatening to greatly increase tariffs by 100%. Investors are concerned that this brings further uncertainty, and as a result, many have been buying gold. A third factor that is particular to these times is concern about the US dollar and its role as the global currency. The US dollar has long been the go-to currency for international trade, particularly with oil, as well as some other commodities. However, the BRIC countries, particularly China, wishes to displace this, and they have their own ideas to oust the US dollar and create either a new universal currency or just replace that with their own currencies. Gold plays a role in this as a potential replacement in a way to the US dollar, and there has been quite a bit of buying of gold from the BRIC countries, particularly China, in recent years. Recently, some of the BRIC countries have started doing trades in oil, and instead of US dollars, they're using Chinese yuan. There's also been buying of gold by investors and central banks that hold a gold as part of their portfolios. Analysts have noted a significant influx of money into gold-backed ETFs. So where do we go from here? Well, let's take a look at what some of the analysts are saying. First, Société Générale just put out an updated commodity report on Monday afternoon, and they are saying all that glitters is fear, as $5,000 gold is now increasingly inevitable. To quote part of the report, with ETF flows remaining strong, central bank buying expected to be resilient, we feel confident and compelled to update our target prices for gold. We now see prices reaching $5,000 an ounce by the end of 2026, as the rate of flows has surpassed our initial assumptions. Despite having no clarity on positioning or flows of hedge funds, we have observed what can only be described as extremely strong, admittedly higher than we forecasted, positive ETF flows in the last few weeks. Why is this increase in flows happening now? We have previously noted a strong relationship between ETF flows and uncertainty levels since the Trump victory in November 2024, and believe for now this to be a critical factor in understanding part of the price action. The analyst said that under the circumstances, it was not surprising to see global gold ETF flows rise by 23 tons over the last week and by 100 tons over the last month. Meanwhile, Bank of America also put out an updated prediction calling for $5,000 gold in 2026, as well as $65 silver. Despite the risk of some near-term volatility and potential consolidation, gold and silver remain in unstoppable trends, as Bank of America expects prices to reach $5,000 an ounce. According to their report, the White House's unorthodox policy framework should remain supportive for gold, given fiscal deficits, rising debt, intentions to reduce the current account deficit, and capital inflows, along with a push to cut rates with inflation around 3%. The report noted that ETF purchases rose by 880% year over year in September to an all-time high of $14 billion US. Similarly, total physical and paper gold investment almost doubled to above 5% of global equity and fixed income markets, the analyst said. As such, we believe that markets could consolidate in the near term. Even JP Morgan's Jamie Dimon chimed in with a positive statement on gold. He's not typically a gold buyer and not typically bullish on gold, but he did have positive things to say in the current environment. I'm not a gold buyer. It costs 4% to own it, he told Fortune's Most Powerful Women conference in Washington on Tuesday. But it could easily go to $5,000 or $10,000 in environments like this. He said, "This is one of the few times in my life it's semi-rational to have some in your portfolio." Also from JP Morgan, David Kelly, the chief global strategist at JP Morgan Asset Management, said the Fed's preemptive rate cuts will stoke inflation, so investors should diversify into alternative and international assets, like gold, to protect themselves. There are analysts out there who believe gold is overbought and do note the potential for some downside risk. However, most really do see more risk to the upside than to the downside. So how might you, as an investor, take advantage of this gold bull market? One option is to buy physical gold. You can go to coin shops and particularly gold and silver oriented shops, and you can buy gold coins as well as silver coins. You can buy gold bars. There are even online sellers of gold bars and gold coins, and even Costco, I believe, has gold for sale as well now. Another option to indirectly invest in the gold metal is through ETFs, ETFs that are backed by gold. A few of the largest of these ETFs include the SPDR Gold Shares ETF, which has the stock ticker GLD in the US. Another is the iShares Gold Trust, which is IAU. Also, the SPDR Gold Mini Shares Trust, which is GLDM. And there are several others as well. Now, one other particular ETF of note that's listed in Canada is the Hamilton Gold Producer Yield Maximizer. This is AMAX on the Toronto Stock Exchange. This is a covered call ETF that holds the shares of some of the larger gold mining companies, but also writes options on these shares that help produce income. So this gives a higher dividend yield while also still having some of the upside from holding these shares of the gold miners. A third option is to own shares of gold mining companies or ETFs that also hold these shares. To gold mining ETFs that I'd note are GDX and GDXJ. GDX has the larger gold mining companies. GDXJ focuses on the mid-tier producers, and these are both from Van Eck. Or you can buy shares of gold mining companies directly. The largest of these currently is Newmont, that's NEM in the US. Second largest now is Agnico Eagle, which is AEM. And third is Barrick Gold, which recently changed their stock ticker to B in the US.
If you found this video helpful and informative, please like and subscribe and ring the bell below to receive notifications about our other videos. We will continue to discuss mining, metals, and investing in the metals and mining space. My name is Tim Lee. I'm a geologist and mining equity research analyst. And thank you for joining us today. We look forward to you joining us on the next one.